Welcome back to SWA's Take 5 Insights. I'm Tendai Jason, joined by Jason Stuber. Jason, we're just going to jump right in. Let's start with the elephant in the room for investors these days, which is centered around asset bubbles. Specifically, we are bombarded with headlines, it seems almost every day, suggesting that we are in an AI bubble. So if this is a bubble, the question is, do you sit it out and risk missing out on potential gains from the projected advancements in AI?
Important and great question, Tendai. And here's the thing, timing investment bubbles historically has been nearly impossible.
Yeah.
History is full of them. We had the dot-com bubble in the 90s, the housing in the 2000s, the credit bubble in 2008, even meme stocks in 2021. And now the AI boom. If you try to avoid every bubble, you could likely miss more upside than you save in losses.
Gotcha. So that makes sense. And so if we are in an AI bubble, you're saying the bigger risk actually is sitting out of it.
Yes, I am. As history has shown us, if your horizon is, say, 8+ years, you may be better off riding the waves and the ups and downs of the market instead of trying to predict the next crash.
Okay, so timelines are always important. And so if I hear this correctly, does age change the equation? So for instance, does a 35-year-old think differently than someone who might be 65?
Absolutely. Every investor's different, but in general, at 35, you've got decades ahead to invest. Crashes, they should be looked at as buying opportunities. At 65, you've got a little less time to recover, depending on your situation and your goals. So diversification probably matters a little bit more. In addition, your age and risk tolerance really should be what's driving your overall strategy, not the headlines. For our clients, this is where investment objective comes into play, because this is what determines how much each client has in volatile asset class like stocks or less volatile asset classes like bonds and alternatives. Younger investors tend to have more stock exposure due to their longer time horizon, while clients who may be retired or close to retirement tend to be more diversified.
So should younger investors almost hope for a crash?
I don't think anyone ever really truly hopes for a crash, but if and when one occurs, all investors, even older investors that have at least some exposure to the stock market, should think of market crashes or even small downturns as long-term buying opportunities. After all, lower stock prices means you can buy more shares with the same amount of money.
Okay, great. So then let's talk a little bit about tech exposure. If someone wants to go in heavy on tech, what should they know?
Well, first I'd say check what you already own. In our last video, we discussed, what fund and ETF and line item actually means in terms of owning an exposure to different companies, et cetera, and sectors. But, you take the S&P 500 index or a fund that's invested like that index is nearly 40% technology sector. If you look at the NASDAQ 100, that's 50% plus tech. If you look at the Magnificent Seven, so think about Apple, Amazon, Microsoft, all the usual friends, they're worth $22 trillion combined. So even if you think you're underexposed, you're likely have plenty of exposure to technology companies. Now, we aim for our clients to be well diversified and have healthy exposure to the technology sector.
Gotcha. So piling on more could mean doubling down what you already own and already have?
Exactly.
Okay.
The thing to remember here is that more concentration in any one particular stock or sector or market typically means more portfolio ups and downs in the future.
Okay, so on the flip side, tech feels unstoppable. AI, robotics, self-driving cars, innovation isn't slowing down. So why not just go all in?
Well, because even unstoppable trends can have brutal corrections. We've seen that in some of the bubbles we talked about earlier. If you believe in tech's future, like we do, increasing your exposure makes sense, and we strive to right-size it for our clients' portfolios. But we never believe you should bet the farm on any one industry or sector or even asset class.
Let's talk about FOMO, the fear of missing out. What about that?
Well, FOMO is a real thing. I have it, you have it, we all have it as human beings, but smart investing isn't about chasing the hottest trend or keeping up with your neighbor's supposed gains. It's about building a plan you can stick with, even when we have crashes and things get ugly. Remember, no pain, no gain. And sometimes lots of pain with no gain.
Okay. Well, that makes sense. So let me just briefly summarize what we've talked about so far today. Should you go all in? Probably not, right? Should you ignore tech? Definitely not. At the end of the day, build a plan, diversify, and invest regularly. Because the only thing harder than timing the market is actually trying to predict the next bubble. Is that right?
Couldn't have said it better myself.
That's perfect. All right, Jason. Well, as always, thanks for simplifying the complex for us today. Should you have any additional questions, please reach out to myself or Jason or anybody else at the Saving Wealth Advisors team. We'd be happy to answer your question. Until then, we'll talk to you next time.